CCLA. And CCLA are the UK's largest charity fund manager. So thank you all for coming along today. And while people are still joining us, do take time to introduce yourselves in the chat and maybe tell us a bit about your experience of all things financial in your organisation or what you're wanting to get out of today. Just a few housekeeping things. We've got closed captions enabled today, but you can turn them off at the bottom of the screen. There's a button there, and we're recording the session. So if you've got any potentially difficult issues that you'd maybe like to discuss privately with us or with our speaker and would rather not do that here, then do get in touch afterwards and we can set up a one-to-one session with you. Also, we will be sending out all the slides to you afterwards in a follow-up email. But I would encourage you to put any questions you've got as we go through in the chat, and we'll have a time at the end to look at those. So I'm delighted today to be joined by Rory McCall, and Rory is Director of WBG, and they're partners with SCVO in our financial management service. Now that's open to SCVO member organisations with an income of under £500,000. And what that does is it provides up to 1 hour of free advice on various areas of financial management, and that includes audits, reporting, and finance policies. So I think for me personally and my colleague Rhonda, we're delighted to have Rory on board to support our members and ourselves on the information service with all things financial. I'm a charity trustee myself, and I know that on many boards, financial knowledge is an area that some trustees can struggle with. And often it gets left to the treasurer, and obviously that's not good governance because all trustees are collectively responsible for financial monitoring and decision making. So it's really great that Rory is going to share his expertise with us today. So over to you now, Rory. Thanks.
Thank you, Tracy. I'm just going to share some slides. Does that all look okay, Tracy?
Yes, we can see that. Thanks. Looks
Perfect.
good.
That's good. Good. Okay. Thank you everyone for coming along today and agreeing to listen to me. I appreciate your time. Hopefully I can teach you a few things about financials. Obviously, we had a previous session a couple of months ago, so today is going to be somewhat of a continuation of some of the things that I discussed there. However, this can very much be standalone as well, and what I'll be focusing on today will be primarily financial reporting, your trustees report, and the concept of charity reserves as well, and then just a few other sort of tips and tricks and things like that, and things to consider too. So what I do, just before I start off, I just wanted to give a wee bit of an introduction to myself and WBG. Obviously, Tracy had mentioned the fact that we work in partnership. I mean, as myself, I'm Rory McCall. I'm a director at WBG, and we're an accountancy practice based in Scotland. I'm a chartered accountant. I've got over 10 years of experience working in accounts and audit. I've experienced in a number of different fields. However, primarily my specialism is in charity audit and accounting, and I head up a firm's charity team. Previously, we were known as Weil and Bissett until sort of partway through last year, at which point we changed our name to WBG. As a firm, we've 12 partners, over 150 staff, working across various different teams. Our office space is primarily based in central Scotland and Glasgow. However, we do have satellite offices around the Glasgow area as well, with recently opened offices in Edinburgh and Aberdeen. As a firm, we work with charities throughout Scotland, some in England, and we're keen to bring our charity accounting expertise into our partnership with SCVO. We aim to provide professional financial management services, advice. We understand the importance and value of the services that SCVO bring to a wide range of charities, so we hope to be able to provide some additional support and expertise as part of that. So as Tracy had mentioned, those members that have income of less than £500,000 are entitled to up to an hour of free advice from WBG in various areas. So that can include things like audit, reporting, finance policies, independent examinations, accounting treatments, management accounts, budgeting, so on and so forth. So plenty of different areas that we cover. If you've got a question that you do want to pick our brains on, you can do through the SCVO website. We have only had the service running for a short period of time. However, we have had lots of interest and queries on topics such as management accounts, budgeting, audits, independent examination, reserves, and things like that. So please feel free to get in touch, and we'll see if we can try and help out. So today, yes, I say we're going to focus on statutory reporting today. I'll start by giving a wee bit of an introduction into the concept of charity accounts generally, where some of that legislation comes from, how that leads into reporting thresholds, and when you have to have an audit and an independent examination and so on. The rules governing how a charity have to prepare its accounts come from two key sources. So we have the Charity and Trustee Investment Scotland Act 2005, which all trustees and charities have to adhere to, and that made provision for accounting regulations in Scotland. Those regulations were originally published in 2006 and are known as the Charity Accounts Scotland Regulations. Those regulations cover all sorts of accounting matters, including what accounting records charities have to keep, the timescales under which they have to submit their accounts to the charity regulator, which many of you will know as OSCAR. They also detail which charities can prepare simplified receipts and payments accounts, and which have to prepare more detailed, fully accrued accounts. And I'll have a look at those thresholds in a moment. The regulations go on to say that charities preparing fully accrued accounts must do in accordance with what's called the Statement of Recommended Practice, or the charity's SORP for short. SORP's an interpretation of UK accounting rules that's specifically applicable to charities, and it sort of gives us a detail of how accounts generally have to be laid out, as well as some of the more detailed disclosures that we have to include as well. So we'll have a look at some of the requirements at the SORP today. I just wanted to highlight as well that the most recent issue of the charity SORP was issued in 2019. Accounting regulations have been fairly static since then. It's not been a fast-moving sector over the last handful of years, which is good. It does make things a wee bit more straightforward. However, we are expecting a new iteration of that to be released at some point this year. So charity accounting rules will change somewhat later on this year. The good news is not likely to affect significantly anything that we'll discuss today. So hopefully everything that we discuss today will remain relevant for the foreseeable. So I touched there on the fact that the charity accounts regulations touch on when charities have to prepare certain types of accounts. As a charity, you can be one of two different types of entity. You can either be what's called a charitable company, where there are all sorts of aspects of the Companies Act that you have to adhere to, or you can also be a standalone sort of unincorporated charity, so like a trust or a SCVO, for example. How you prepare your accounts can differ between whether you're a charitable company or a charity. If you're a company, you have to prepare what's called accruals accounts, where you recognise income in the period to which it relates. However, if you're an unincorporated charity, you have a choice depending on your level of income. If a charity earns less than £250,000, it can prepare what are called simplified receipts and payments accounts, where we just account for money as and when it comes into our bank or when it gets paid out. They're very, very simple accounts and are easy to account for. If you have income of more than £250,000, we have to prepare true and fair view accruals accounts, and they sort of tie in. They're very, very similar to charitable company accounts. So income levels do affect the financial reporting that you have to undertake. And income levels also feed into when a charity has to have an independent examination or an audit as well. Broadly speaking, the key threshold for charities in Scotland as to when they have to have an audit is £500,000. If you earn less than £500,000, you don't have to have an audit. You can have what's called an independent examination. However, the year in which your income reaches £500,000, you must have an audit undertaken. There is also another threshold which comes into play there. If your assets are over 3.26 million, you also have to have an audit, even if your income is less than £500,000. So that comes into it too. An audit can also be required for some other reasons as well, not just driven by income levels. So, for example, some charities might have it stated in their governing document that they have to have an audit, or someone that's a third party, such as a funder, can request that you have an audit, or the trustees can actually request that the charity has an audit as well. So whilst those are the financial thresholds that determine whether you have an audit or an independent examination, they don't automatically set in stone. There can be other factors that come into it as well. Just wanted to highlight as well that these thresholds do differ from the rest of the UK as well. Your thresholds in Scotland are a bit lower than what we see in England and Wales. England and Wales, their income threshold is £1 million. So unfortunately, lower income levels for charities here in terms of when they require an audit. I just wanted to touch as well on what the difference is briefly between an audit and an independent examination as well. An independent examination is a form of scrutiny. You do have someone independent to the charity looking at your records. However, it's far less detailed than what you would see with an audit. And the independent examiner's report tends to go into a lot less detail as well. An independent examiner's report tends to only be around about 1 page. An audit report in a set of accounts usually extends to 3 or 4 pages, and it touches on lots of different information. An independent examination is really focusing on ensuring that a charity has kept proper accounting records and that the accounts are correctly prepared and agree with those underlying records. So an independent examiner will probably prepare your accounts as well. Essentially, they're ensuring that the numbers that are reported in the accounts just agree with the records that you've kept during the year. An audit goes into a lot more detail than that. And an audit actually presents an opinion as to whether accounts present what's called a true and fair view and are free from material misstatement. So an audit will do lots of different things. It'll sample test income, expenditure, assets and liabilities of the charity to assess the completeness, existence and accuracy of the figures reported. Tends to look at lots of other things as well. It'll look at non-financial aspects. It'll look at compliance with laws and regulations. It'll probably look at your governance setup as well and see if there's anything which needs to be material reported to the users of the accounts. So it tends to be a lot more work, a lot more involved in it. I think most people, if they can avoid an audit, would typically want to try and avoid one, just due to the additional cost and burden of it. So yeah, try and stick to the financial thresholds if possible. Consider if you do have an audit completed voluntarily, do you need one? Obviously, it's a big burden in terms of the governance and the resource of a charity. So it's certainly something if you're having completed voluntarily to consider whether that is absolutely required or not. Other sort of accounting considerations to consider too, the audit thresholds, which I referred to a minute ago of £500,000, do apply to each year on its own. So if you breach an audit threshold 1 year, that doesn't then mean that you have to have an audit undertaken every single year thereafter. It applies to each year on its own. So if you're £500,000 this year, you have to have an audit. If you drop back under that threshold next year, thankfully, you can go back to an independent examination in most cases. So that can be helpful to some charities who have a large one-off receipt, such as a legacy, for example, which pushes them over that threshold. It doesn't mean they have to have audits continually thereafter. In terms of filing deadlines, all charities have to file their accounts with OSCR You have 9 months after your year end to do that. If your charity is also a company, you have to file your accounts with Companies House as well. That is also a 9-month filing deadline as well. So those deadlines do tie into one another. You can gain extensions to those at Companies House if possible, if you request them in advance, or otherwise fines can apply if you're late in terms of filing accounts at Companies House. Oscar tend not to fine for late filing of accounts, but they do put on public record if a charity has been late submitting them. One final threshold just to note is the larger charity threshold. The larger charity threshold thankfully actually ties into the same thresholds for audit. So a larger charity is any charity which earns over £500,000 or has gross assets of 3.26 million. Those charities which are below those thresholds do gain a number of disclosure exemptions in their accounts and can prepare much shorter, less detailed trustees reports. For those charities that are above that threshold, there are additional disclosure requirements. They do need to be much more detailed and transparent in their trustees report. There are some other areas they have to include. So, for example, some additional notes to their accounts. They have to include a cash flow statement as well. So those larger charities do have to include some more detail. Again, these thresholds haven't increased in a long time and are much lower than the small company thresholds of £10 million of turnover or the English and Welsh charity thresholds as well. So one of the key things that threshold tends to feed into is the content of your trustees report. So the trustees report, what's included in that is determined by the charity SORP, which I referenced up front, which are the accounting rules for the United Kingdom. Charity SORP determines what has to be included. And that's broken down into a number of statutory headings. So that's things like reference administrative details, so admin details about the charity, who the trustees are, what its addresses and bankers and so on and so forth. Structure, governance and management, objectives and activities, achievements and performance, financial review, and plans for future periods. So those are the sort of key statutory headings that you get in the charity SORP. However, that is a minimum level of content and can and should be expanded upon. So it's hopefully not a case of just trying to hit the absolute bare minimum. You should, from a statutory point of view, be trying to provide more information than just hitting those key headings. But from a making the charity attractive point of view, you also want to be trying to provide more detail than just what you're required to under statute. One of the areas being an accountant that I also wanted to touch on as well was the financial review section of the trustees report. I tend to find in my experience that the financial review section is a frequently underutilised section in which a lot of charities often provide the minimum level of required detail that they can. A lot of the time that's just because they're uncomfortable with what has to go in there. They're not really sure on what should be getting reported upon. The financial review section does provide a good opportunity for charities to explain the reasons behind the figures that they're reporting in any year and also explain future funding requirements as well. Many charities are struggling to fundraise at the minute. I know in the aftermath of the pandemic, there has been significant competition for funding. So financial review section may be a good way of setting out your stall for why you need to raise additional funding. So things that you might want to include in your financial review section are talking about the financial position of the charity with reference to your available funds, any significant events which have impacted the charity during the year, if there's any significant one-off pieces of funding, such as a large legacy or a large grant, or if any funding has perhaps come to an end, which you feel you want to draw to a reader's attention, then that's certainly something that you should think about too. What your current principal funding sources are, who your main funders are, any requirements for additional funding, plans that you have going forward and where you might need additional income. And then you should also include some risks and uncertainties, particularly financial risks, and also a reserves policy as well, which I will come on to later in terms of how that should be calculated. OSCA, the charity regulator, do check every set of accounts which are lodged. They don't look at every single one in detail, but they will take the key points and report on them. They do tend to take a sample every year and look at them in a wee bit more detail. And based on that detailed sample, they have come up with a number of key tips to consider when you're pulling your trustees report together. So those are to take control. Remember that the charity trustees own the trustees report. They should be in control of what goes in the report and how it looks. Having that strong impact from the top will ensure a cohesive and quality report, which is geared towards the stakeholders that the charity should be reporting to. Tell the story, consider why the charity was set up in the first place, who it helps and what was achieved in the year. Remember that a lot of detail should be provided on its objectives and activities, so the report should really aim to sell on that as much as possible. Use the opportunity to speak to people. The trustees report is one of the key ways that the charity interacts with the public, and one of the first documents that funders will look at when making their funding decisions. So use the report to explain to people what you're doing and how they can help with your activities. Be creative. Don't get too bogged down in text and jargon if possible. Use pictures, charts, photos, even links to videos to show how the charity is doing. It can be easy to capture the imagination and visually demonstrate what's being done rather than just relying on a wall of text, for example. But having said that, don't forget the legal bits as well. As I noted, the charity SOP does have those legal requirements. There is a bit of a balance to be struck between including that detailed information on the charity and ensuring the key headings required by the charity SOP are met. I do review a lot of sets of charity accounts. It is quite common to either see trustees reports which include all of the statutory legal information and no expansion on that, or it goes into loads of detail about what the charity did during the year, but doesn't actually hit the statutory requirements. So you want to be able to produce a quality document that has a good balance of both. Here's what we need to include, but also here's some additional information that really shows what the charity is doing. So yeah, share what you've achieved, say what you're doing in future, and try and use the trustees report to set the scene for why you deserve more funding. So tying into the concept of reserves, to move on to that, I wanted to touch first on the concept of fund accounting. Reserves are particularly important to a charity, and they play a key role in demonstrating financial management to your funders. All charities under the charity SOP are required to report under what's called fund-based accounting. Now, typically you have three types of fund which charities have to report on. So you have unrestricted funds. They are fairly simple, do what they say in the tin. That's primarily where you receive income from a donor or from some other source that you can do what you want with it. It's not earmarked for a particular purpose. You can spend that on what you like. You also then have designated funds, which are a type of unrestricted fund. This is where incomes come in, and the trustees have decided that they want to spend that money on a certain purpose in the future, and they earmark it for that certain purpose. So it is unrestricted. It's just something that the trustees have decided that they're going to spend money on. You then also have restricted funds as well, and these are essentially the opposite of unrestricted funds. It's where you receive money which must be spent on a purpose imposed by the donor. They're not readily available to spend, and they should be ring-fenced in your accounts for that specific purpose as far as possible. So just to put that into a handy graphic format there, down the left-hand side, you have two types of unrestricted fund. You have your sort of general unrestricted funds, and you have designated unrestricted funds, which you've designated for a specific purpose. And then you have your restricted funds. Within those restricted funds, you can also get other things such as endowments as well. They tend not to be too common endowments, but if you do ever come across an endowment fund, they are a special type of restricted fund. Just a few things to mention about restricted funds. So as I say, they're subject to restriction on use imposed by a donor or funder. So in simple terms, if a donor provides, say, £10,000 to go towards the purchase of a new minibus, that £10,000 then has to be spent on that purpose. The trustees or the charity can't decide just to spend it on something else. Restriction can't typically be lifted unless the donor gives express permission to do so. So if you get £10,000 to buy a minibus and you manage to grab yourself a bargain and it only costs you £8,000, the remaining £2,000 still remains restricted towards that purpose. So you would have to spend that £2,000 on a minibus, or for example, parts related to a minibus. That restriction can only usually be lifted unless you go back to the donor and ask for them to lift that restriction on it. You can also get self-created restrictions. So if, for example, you have a fundraising event where you say that you're going to raise money for a certain purpose, any money raised as part of that would also be restricted. So if you say, I don't know, for example, it was again, I'm going to use the minibus example. You say we're having a fundraising event to buy a new minibus. Any money that you raise from that fundraising event would have to go to that minibus. So that would be restricted income again. Restricted income, it's really important to sort of monitor that on an ongoing basis as part of the financial reporting requirements of the charity. So what we want to be doing is if we do get restricted income coming in, make sure that we're recording that separately, and make sure on an ongoing basis you are recording what you're spending that money on so that you can properly keep track of how much you have left. Designated funds, so as I mentioned up front, those are not restricted. It's just monies that the trustees have designated towards a certain future purpose. If you do decide in future that you don't want to spend money on that fixed purpose, you can actually undesignate it in the future. You're not creating any sort of legal restriction by designating it. So not something that you have to keep it towards. Some typical areas you might see designated funds, so amounts tied up in fixed assets. Sometimes see designated funds created which agree to the balance of fixed assets because you can't readily spend fixed assets and you don't want them to be part of your general funds. Then things like essential future expenditure. So if you know you've got a repairs and maintenance project on the horizon, you might want to designate some money for that. And then things like hopes for the future as well. It can be aspirational things. So for example, if there's a big anniversary coming up for the charity that you want to set some money aside for, again, I've seen designations for that. Designated funds are quite good because they can be used to manage your reserves position. Where your reserves are too high or they're higher than desired, you might want to consider future spending requirements, what potential designations there may be, because if you designate some money, it takes it out of your reserves position and it lowers your available reserves. So if you do find it's too high, the trustees may want to think about what sort of things they might want to designate some money for to lower that pot. Calculating reserves. So I've spoken about funds. Reserves themselves are the funds that your charity has which can be freely spent on any of its charitable purposes. Your reserves position is calculated as your total unrestricted funds less anything which is designated, tied up in fixed assets, and specifically excludes restricted and endowment funds. So unrestricted funds, less anything designated or in fixed assets. What charities want to have as well is what's called a reserves policy. And the reserves policy is a target level of reserves that you want to hold. I thought it'd be worthwhile touching briefly on some common reasons why charities might want to hold reserves. Obviously, you're always going to want to hold something in reserve, but some reasons why you might want to hold them. It's important to highlight that the reason for holding reserves is unique to the charity, and it's down to the trustees to determine an appropriate amount of reserves to hold. So some common examples, obviously not limited to, but to protect against an unforeseen event leading to a fall in income, an amount required to meet all liabilities if the charity ceases trading, for working capital requirements, if you need to meet expenditure ahead of funding being received, or things like to protect against unplanned events, such as a loss in staff or damage to assets as well. But there are obviously various other reasons why a charity might want to hold reserves, and there's no right or wrong answer to this in current regulation. I mean, the policy is entirely at the trustee's discretion. It's not prescribed under any law, by OSCR, or under charity accounting rules. Trustees should be looking to select an appropriate policy, so they should stop and consider what the right level of reserves are for the charity based on the nature of its activities and its funding profile. I do think it's quite common to see many charities select 3 or 6 months of expenditure as their reserves policy. There's absolutely nothing wrong with selecting that amount, but if such a policy is chosen, that should be because the trustees feel that that's an appropriate amount of reserves to be held. It's not a level which is based in any legislation or guidance. Once you select a reserves policy, it's important that the appropriateness of that is regularly reassessed in case any changes need to be made. You don't need to keep a reserves policy as your policy forever. So if the trustees collectively decide that the current policy is inappropriate, it can be changed, albeit it's uncommon to see that change all the time. Lastly, you need to make sure you're comparing your actual reserves position against the stated policy in your accounts. You could also include that in your management accounts if you have them as well, to help aid decision making. And it's important at the year end that you stand back and consider the desired level of reserves against the actual. Significant deviations from that reserves policy could impact on your ability to attract funding. So to move on from reserves, I'm just going to touch very briefly on some charity-specific disclosures and how charity accounts are laid out. Just a couple of differences that you'll see from company accounts. Company accounts, we tend to have what's called a profit and loss statement, where you take your income for the year, you deduct your expenditure, and you get left with ultimately a profit or a loss. Charities aren't really set up to make profits or losses, so we present income and expenditure slightly differently in the accounts. A charity's income and expenditure statement or profit and loss is known as a statement of financial activities. This graph is taken from the SORP and isn't particularly user-friendly, but hopefully you'll see up the top there that we split our income and expenditure out into unrestricted, restricted, endowment funds. You can do designated funds as well if you wish. Down the left-hand side, we report income and expenditure on what's known as an activity basis. So we split income and expenditure out between donations and legacies. We report on what our charitable activities are, so why the charity was set up in the first place and what various different activities we're doing. And then we also report other things as well, so any income from trading activities, any income from investments such as interest as well. So we report income and expenditure on those basis, and essentially what the SOFA, the Statement of Financial Activities, allows us to do is match the income against costs for each different activity the charity carries out. There is some discretion as to how your costs can be allocated to each activity. So when preparing accounts, you want to have a think about every cost that the charity incurs. What are you actually expending it on? Is it allocated to the correct activity in our accounts? Because a funder can pick up a set of accounts look at how each activity is performing, determine whether that is reporting a surplus or deficit, and make funding decisions on the back of that. So I'm not going to go into the detail of various different types of cost categories today, but there are things in your accounts called support and governance costs, which allow you to allocate your cost to each different activity. So when you're pulling your accounts together, try and have a look at the activities and the notes of the accounts, have a look at the costs that are being reported, have a look at surplus or deficit in each, and have a think about whether the costs being reported are appropriate or not. Good news is, whilst the income and expenditure is reported differently in your statutory accounts, your balance sheet is very, very similar to what you would see in a company balance sheet. It's a fairly traditional format. For those that aren't familiar with it, a balance sheet is reporting all your assets and liabilities as at the year end. So it'll report your cash, any amounts due to the charity, any amounts paid out, and it'll report an overall financial position. The good news is that it's very, very similar to a company balance sheet, and no significant differences which most people would notice. And a set of accounts as well, you also get a cash flow statement that is required by the charity SORP. Typically, those that earn less than £500,000 wouldn't have to include a cash flow statement. However, those larger charities over those thresholds do. Charity cash flow statement really tends to be a reconciliation of how your cash moved from its opening position at the start of the year to the closing position at the end of the year, based on a factor of its income, its expenditure, and working capital movements. As an accountant, the cash flow statement in a set of statutory accounts does provide some useful information, but I think the cash flow statements, which I tend to find much more useful, are your internal cash flows. So looking at how you expect cash to move in and out of the business in the future. But I just wanted to highlight that that is something which most charities need to include in their statutory accounts. So a few charity-specific disclosures which have to be included in your accounts too. Trustee remuneration is one. If there are any trustees who are remunerated as part of their role as a trustee or an employee, the accounts do have to note the fact that that remuneration was paid, and that's on a named basis. So the trustee has to be individually named and details provided of any remuneration which was paid to them during the year. You also have to disclose any trustee expenses, so amounts that were paid to trustees, or any amounts which they could have claimed but didn't. So that has to be included too. That's on a global basis, so individual trustees do not have to be named there. You can just note the total number of trustees who were paid expenses and the total amount. Likewise, any restricted donations paid by the trustees to the charity have to be named too. Again, on a global basis, just the total amount of donations received and how many trustees paid donations. Any related party transactions, so they may be they may be transactions that the charity undertook with, for example, an organisation in which a trustee holds an interest. So if a trustee owns their own business and they carry out work for the charity, and the purposes of transparency, the accounts have to disclose who the trustee was, what the name of that organisation the charity transacted with, and the total amount of any transactions during the year. Accounts also require that even if there are none of these such transactions, you have to disclose the fact that there are none. So a disclosure has to be made regarding these areas in some way, shape or form in your accounts. Some other areas which we have to include regarding employees, we have to disclose remuneration paid to key management personnel. Charities should determine who their key management are. That's at your own discretion. However, typically key management would be things like the trustees, a chief executive, any members of a senior management team as well. For that, key management personnel we have to note what the total amount of remuneration paid to them was during the year. Again, that's not on an individual basis. That is just the total remuneration paid to members of key management as a total. We also have to disclose the total number of employees on an average headcount basis. We have to note the number of any employees who earned more than £60,000 in a year. Again, that's also not on a named basis. All you have to do is in bandings of 10,000 upwards, so 60,000 to 70,000, 70,000 to 80,000, and so on. You just need to note the number of employees who earned in excess of that threshold. And then a couple of other contributions that have to be disclosed too. Contribution of any volunteers, not on a financial basis, just the general level of contribution which they gave to the charity during the year should be recognised in some way. And lastly, if there are any significant redundancy or termination payments, they should also be disclosed. That's also obviously not on a named basis. It should just be the total amount of redundancy payments which were made during the year. That one I have seen a lot of the time, if it's going to breach any sort of confidentiality arrangements, it doesn't need to be disclosed, but typically the charity SOP does ask that information is presented in your accounts. So before I finish up, just a couple of areas to consider when you're pulling your accounts together, some sort of concluding areas and funders and what else you can look at. Some areas, these aren't really an exact science, but more just things that I've picked up over time working with grant funding bodies. It's important to remember that grant funders generally aren't accountants most of the time. Me, because I'm an accountant, I usually pick up a set of accounts and I'll look at the numbers first. However, grant funders typically tend to look at the narrative first because that's what they're comfortable with. That ties into what I was discussing and sort of highlights why narrative is important. It's often the first bit of the report which they'll open, and the bit that your stakeholders are going to be interested in as well. So ensuring that you've got a high quality trustees report can be very, very important in terms of swaying funders. Funders will probably be admitting as well they can be swayed somewhat by a human element as well. So you might want to consider including stories from beneficiaries or photos to help grab their attention as well. Sort of touching the beneficiaries and what you're doing to support them. Quotes from beneficiaries can potentially be included too to show how the charities assisted them. Use facts and figures. Measure performance against KPIs to quickly demonstrate what the charity is doing as well and what difference it's making. It's important to try and make funders' decisions easy for them. So make sure there's no inconsistencies between the words at the front and the numbers at the back. The numbers part of the document shouldn't really be an afterthought, and the two aspects of the document should tie into each other as far as possible. Lastly, aim to use the trustees report as an opportunity to sell anything unusual which you might see in the accounts or any difficulties the charity's had to encounter, particularly in terms of the numbers. If the charity is experiencing financial issues or if there are any significant events disclosed in the accounts, it is usually much easier to address those head on in your trustees report so that a funder stakeholder is aware of them rather than having to have them clarify separately or at a later stage. And lastly, some other things that you might want to consider as well from personal experience. Leave plenty of time for drafting your trustees report. It's really common for me to see charities leave drafting a trustees report to the last minute. That can often lead to a bit of a low quality document at times, which doesn't meet the target audience or the requirements of the charity sort. Drafting throughout the year as a working document is something that you might want to consider, but please try not to leave it until the absolute last possible moment. Leaving it late on is often exacerbated by not having up-to-date information to hand as well. Have a think about throughout the year about what sort of things you might want to have included, what information you're going to need, and ensure that it's going to be on hand when you get to the year end and you're pulling that report together. If necessary, consider additional disclosures as well. If there's any additional issues that you want to raise, there typically aren't that many rules in the charities SORP which stop you from disclosing them. Often I find reports can just be delegated to the chief executive or finance director to draft a report on behalf of the trustees. I do tend to find when that happens, it can just lead to a bit of a one-dimensional report. So try, if possible, to get various different individuals to contribute and feed in with their parts. Leave time for the report and for critical appraisal as well. The more time that the trustees have to review a report, the more time there is for constructive criticism to be implemented into the wording of it. It's important to ensure consistency throughout the document and that the narrative doesn't contradict itself. So if you leave review time, that's going to ensure that. And then lastly, try and use the opportunity to thank those who've contributed to the charity as well, including volunteers and funders too. You should look to highlight the work that the charity can undertake thanks to their assistance, which may encourage them to provide further funding going forward. Okay, I think that's everything I wanted to let you know about in terms of charity accounts for just now. I think, Tracy, you'd mentioned up front that if there's any questions, which I'm happy to take on either statutory accounts generally, or if there's any other questions in financial management, I'd be happy to take those.
Thanks, Rory. That was great. There's a couple of questions coming in. I wanted to ask something actually about, well, certainly I wanted to echo about if you don't need an audit, get that changed in your governing document because they're expensive. And I know getting an auditor can be quite difficult. We've certainly heard from our members anecdotally that that's the case. But, in an audit, Rory, I'm just wondering, you said they would look at your governance structure. What would that involve? What would an auditor comment on?
I think I want to try and distinguish between what myself as an auditor and what my firm looks at, and also actual things that you have to look at. Typically, we want to be ensuring that the trustees are actually undertaking their duties appropriately. There are various different requirements in terms of the Charities and Trustee Investment Scotland Act. Requirements set out by Oscar as well. We would want to ensure that the trustee board is properly constituted, that it's adhering to those laws and regulations, that it's meeting appropriately, that it's essentially undertaking its statutory duties. So that's certainly something that we would look at as part of an audit. As a firm as well, what we try to do is collate various different things off the Oscar website in terms of good governance practices. So not necessarily things that you have to do, but things that you might want to consider. We do look at, so for example, if there's an induction policy, if you're doing appraisals, things like that, we also tend to look at that as well, just to give a few pointers and add value to some of the charities that we work with. But primarily it's from a legal standpoint, that's the sort of thing that we'd be looking at in terms of governance.
Okay. And would you feed that back to the trustees sort of like internally, or would you put that in a report if those kind of things were really glaringly missing? Most
of the time it would be fed back to the trustees internally, unless it was something significant. As an auditor, you do have whistleblowing requirements to Oscar. So if you felt that there were things in place which would potentially lead to a loss of charity's assets, or if the charity just completely was not governed properly, we would have whistleblowing requirements in terms of that. But most of the time, if it's not something significant, we just report on that internally.
Yeah. Okay, thank you. Well, we've got a couple of questions in now. I can ask them, but do raise your hand if you want to ask something yourselves. Jack's asking, how are volunteers' contributions measured? Is it the hours worked, or do you have some kind of value that you look at?
It's a difficult one. Typically, it doesn't tend to be value. The charity SORP specifically says that you don't incorporate a value, so I wouldn't necessarily waste time coming down to a very, very specific figure that you would want to include in your accounts. But I think potentially, yeah, if you want to include a sort of broader general value as to what they contribute, that might be helpful. Sort of areas that perhaps can operate without them, what they tend to do on a day-to-day basis. Those are probably the things that you want to be including. The disclosure is not, it doesn't have to be particularly significant. Most of the time it tends just to be a paragraph or so, 2 paragraphs maybe, which comment on how the charity couldn't function without volunteers, if that is the case.
Great, thank you. Is it common for trustees to write the report collaboratively? Because somebody's saying, you know, it's often prepared by the charity's leaders, so it would be this, maybe the CEO's input, and just presented to the trustees for signing by the chair. Is that considered poor practice, would you say?
I probably want to distinguish between poor practice and something which I think charities might want to consider. I don't think it's necessarily poor practice for someone just to write a report and then present it to the trustees for drafting. I think it's more just an area that you could potentially get more value out of your report if various different people are feeding into it. I don't think it's something that every single trustee needs to be writing their own section, but I mean, I work with charities where, for example, they may have an admin function, they have 10 trustees, and then they have like a fundraising department. They might have a finance department as well. And sometimes in those cases, I still find that it's one person that writes the report on behalf of everybody. Whereas there are very much sections within that report that could be delegated and have people that it makes more sense for them to be writing it. So I think having that level of collaboration definitely does help. But if that's not the way you're doing it, it's not to say that you're wrong in any way. It's more just somewhere that I tend to find in my experience, it does lead to a slightly better quality of report.
Yeah, yeah. Thank you. Sophie, you've unmuted. Do you want to ask your question yourself?
Hi, yes, please. Thanks very much for your presentation, Rory. It was very helpful. My question is whether you have any advice about how to present a cash flow forecast, and if there's somewhere I can kind of get a standard model. So, for example, so really what I'm looking for is projecting ahead for a couple of years and helping the trustees to identify where funds are really dipping away to the, and kind of at what point ahead they have to look to be maybe taking action where funds might be dipping away. And obviously then that point can move on. But I've just been struggling to find something that could provide me with that model.
I don't know if someone else is going to say something there, but personally, I don't have anything which I'm aware of as an external resource. What I was going to say is this is probably something that I could help you out with directly. I have had a couple of queries come in through the SCVO help desk, which I mentioned at the start, where we've helped people with this already. And I do have colleagues that have templates that might be of some use to you. So if it was any benefit, if I don't know, Tracy, if I'm able to get Sophie's details, but I could certainly help with that directly.
That
Or
would
my colleagues may be able to do so.
I'll put it in the chat. And I did my new model, but it's not very pretty looking. So it'd be brilliant if you can help. Thank you.
No problem.
Great. Sophia, is your organisation a member of SCVO?
Yes, yeah.
Right. Okay. Well, we can sort that out. That's great. Thank you.
100,000.
Great. Lorraine's asking for your advice, Rory, on self-created restrictions during fundraising. So is that the kind of correct thing to do, or is it okay to just raise money for general funds?
I mean, I think when I discussed about that, it's probably more just about being careful about what you're saying to fundraisers if you are creating an expectation up front. I mean, if you just have let's say a coffee morning or something like that, or a fair or that sort of thing, where you say you're raising money for the charity, that's absolutely fine to do that. It's more just to be conscious that if you're raising money for a specific project, for example, and you give people an indication that that's what it's going to be for, you just have to be conscious that that is then what you have to spend that money for. You can't turn around at a later date and say, actually we're not going to spend it on this anymore, we're just going to spend it on salaries or something like that. It's more just to be conscious about the fact that is the case. There's no right or wrong in terms of what you have to advertise. It's more just the fact that a self-created restriction does exist. And if you're going to do that, you just need to make sure that you're monitoring those funds properly.
Yeah, going back to that minibus, if that's what you're saying, you're raising the money for, then that's really what you have to spend it on, isn't it?
Yeah, exactly. You can't then say, oh, we're actually going to spend it on a new extension to a property. It's not the way it works.
Yeah, yeah. And Brian is asking, this is a good question. They only registered as a charity this month. So what's your top tip for helping them get started with good practice from the get-go?
From the get-go, it depends on what resources you have available to you. I would have said, if at all possible, utilize what's on the Oscar website. There is so much good information on the Oscar website for new charities in terms of what you need to consider in terms of getting set up with your financial reporting, in terms of internal financial management practices, what sort of things you need to consider putting your statutory accounts, so on and so forth. There's a wealth of information on there, which is really, really good for charities. And I tend to find actually, when we are getting some referrals from SCVO, one of my first sort of ports of call is to refer them to a specific section of the Oscar website where they've reported on things already. So have a look at their financial management section. There's loads of good stuff on there that's really, really helpful and presented in plain English. So that I would have said there. There's also stuff on the English equivalent. So the Charity Commission website, there's lots of good stuff on there too. Most of it, because it relates to charity governance, is still relevant. So I would also have a look at that as well.
Yeah, I think the Charity Commission, they've obviously been in existence a lot longer, so they do have a lot more resources than Oscar do, and some of them are very useful. Yeah. I'm going to take one last question because we are still running out. We're just about running out of time. Lisa's asking, is there any software that's best to use for restricted versus unrestricted funds? Because they're finding that quite complex. They had a funder pay them a lump sum. That was easy to track. But then they had money from Scottish Government and it was claimed after spend every 3 months. So they wanted some kind of software to keep track of that.
Sadly, that's one I'm probably going to struggle with because I tend not to use accounting software on a hands-on basis too frequently. I do know from personal experience, a lot of my colleagues complain about Sage in terms of its monitoring levels. They find that really difficult to work with. I think they do like working with Xero in terms of monitoring these things, but I mean, this is just speaking anecdotally to a couple of my colleagues. I think if again, this is one I could maybe have a chat with someone offline about. I'd probably need to go and speak to a couple of colleagues and see if there's any other options available to them. Because I'm really just working off who in the office has a grumble about certain things and who doesn't.
That's fair enough, and I suppose it's personal preference as well, isn't it? Lisa, if you get in touch with us via inquiries at scvo.scot or through your membership account on the website, and we can certainly put you in touch with Rory and he could help you further with that. So thanks so much, Rory. That was really useful. As I said, the slides will go out, and if you have any questions that haven't been answered, do get in touch with us. Rory's going to be joining us at the gathering, which I hope you'll all be coming along to on the 4th and 5th of February. We'll be running a good governance session there, and there's lots of other sessions that trustees would find useful. So we'd love to see you there if you're able to come. And finally, our next webinar is on the 18th of March, and that's with our partners CCLA, and we'll be looking at furthering financial resilience and the important role of investments. So thank you again for coming along today, and hopefully we'll see you at the gathering. Thank you. Bye-bye.
Thank you. See you later.